Let's connect with Anshul Saigal as well, who joins in on the show. Anshul, why don't we get in your take then as to how you're looking into the move within some of those stocks like PFC and REC clearly came under pressure in trade yesterday on the back of the RBI guidelines. What do you advise investors to do now?
Good morning. Um, Rather than get into individual stocks, in general, there are pockets in the markets where there is still opportunity, but this is not a time to be chasing stocks. And the names that you mentioned, those have rallied significantly over the last 1 year, as much as 4 to 5 times and even more. And to be chasing them in the anticipation that they will do something similar going forward is not really being prudent at this time, particularly when the markets are not cheap. As a result, it is better to be in pockets which have really not performed so much in the recent times because of either weaknesses in their environment or weakness in company specific reasons. It is there that there will be money made going forward on a risk adjusted basis. So I wouldn't suggest that one should be chasing stocks. And just like the previous speaker spoke, that one should be more cautious in PSU banks, and there is opportunity in private sector lenders for various reasons. I kind of concur with that, and on a risk adjusted basis, that's the opportunity which will likely offer greater returns going forward. And then, of course, there are other pockets in the market where one can really look at risk-adjusted returns.
Right. So, what is the strategy then, Anshul, right now? Would you say book out, from your portfolio, take profits off the table, keep the powder dry because the next month and a half is bound to get volatile till the election result is declared?
Morning, Aisha. It's not so simple to do that because you've been in the markets long enough to know that markets during election time can throw up quite a varied sort of options for players. I mean, if you go back to 2004, markets were down circuit after elections. In 2009, markets were up circuit. And then, of course, in 2014, markets were rallying before elections and they continued the rally thereafter. Now, we are in a phase today where we are close to, of course, elections. Markets have rallied before. So clearly, one has to be cautious. But this is not a time to be sitting on cash because we really don't know what the event is going to throw up. If the event throws up a favorable decision, a favorable in the context of what the markets are seeking, then clearly sitting on cash will not be a good strategy. So this is a time where, of course, one should really improve the quality of the portfolio. If you're in weak balance sheets, if you're in startup kind of names which are up 10, 20 times in the last 1 year, then taking some money off the table there is really a prudent strategy. But sitting on cash, I would not advise at this time. This is a time to be invested in quality names and in names which are down 20, if they are down 20, 30%, you will buy more because you have confidence in their business models. So that is the strategy that I would advise. It is a strategy that I'm following. I'm not sitting on cash, not a significant amount of cash, anyways. And we are suggesting that investors should do the same.
That's the view coming in. Meantime,
I just wanted to discuss the prospects of FMCG because more and more companies which are coming out with their numbers, it clearly indicates that the rural recovery is very much in place. In fact, in few cases like a Dabur, it's actually rural growth which is done better than urban.
Yeah, Aisha, that I couldn't agree with you more actually, because clearly over the last, say, 1.5 to 2 years, it is the rural market which has been quite weak, and the urban markets have been quite robust. So all urban related consumer discretionary names were doing well. Even general consumer names were doing well, while consumer names which were linked to the rural market have been quite weak over this period. In fact, one of the things that comes out from this sort of observation of yours is that a bull market is a narrow bear market. What I mean by that is that while there has been a raging bull market over the last 1 year, but if you look at consumer related stocks related to the rural market, those have really languished. Some of them are down 50% from their recent highs. And that tells you that if the rural market was to turn, it is here that there is opportunity because valuations are favorable and no expectations are built into these stocks. And of late, like you rightly mentioned, many of these FMCG companies are indicating that there is a rural recovery in the wings. One name you mentioned, the other is a large biscuits player. Even that company mentioned that there is a revival in the rural story. And even anecdotally, if we were to think about India in general, if India is going to do well, rural has to do well. And this is only a temporary phenomenon that rural has been weak. As a result, I do agree with you that it is in this segment that there is opportunity at this time. And for the patient investor, risk will be highly rewarded here.
Okay. But Anshul, it's often said that if you're buying gold at the price of diamond, you're not going to make money. So FMCG companies are gold. But 70p, 80p, 90p, history's taught us from here you don't make money.
Nikunj bhai, if you get Malabar Hill at prices of Worli, would you buy or not? And even Worli prices look expensive on an
I tell
absolute
everyone that
basis.
stay in a rented house these days.
That's a smart investor. Rental yields are low, so clearly you're smart at investing your monies. But anyways, the point is that even on an absolute basis, Worli prices are expensive, but Malabar Hill is clearly far more expensive than that. Some of these names that you mentioned, see, these FMCG companies, they are such high quality companies. They give you 110, 120% return on capital employed. And there is no way that these companies are going to trade at cyclical multiples. It's not like these companies are going to come down to 15, 20 times price to earnings. The question is, for the quality that they have to offer, are they trading cheap or not? So clearly, in names like this, maybe even 40 times, 45 times price to earnings is cheap. While that may not be the case when you're considering a commodity player or a utilities player. So that's the context in which you have to look at these companies. Growth has been weak. As a result, these companies have consolidated for the better part of the last 4 to 5 years. Given where growth is anticipated to be over the next 2, 3 years, if growth does pick up, then these companies may offer opportunity. In any case, downsides are limited here. So if you want to hide, this is the space to hide.
I distinctly remember when we had a conversation last time, you said, "Kuch bhi le lo manufacturing mein." Are you still buying Are you still buying manufacturing stocks in your portfolio aggressively?
Nikunj, I'm a big bull on that space for the next 5 years. I think that we are only scraping the surface. In the last 2, 3 months, many of the names in manufacturing and capital goods have nearly doubled. And in our judgment, of course, easy money is off the table. But if you're patient, your patience will be rewarded handsomely over the next 3, 4 years. Let me give you an instance. I was speaking to a company which is in the business of pumps and valves. This is a Japanese major which has set up shop in India for the last many years. The Japanese major has raised stake in the Indian subsidiary because they find opportunity here. And what they are saying is that it is very clear that they want to diversify out of China. But instead of going to countries like Taiwan, Korea, etc., they are coming to India because India offers them a large domestic market, which those countries don't offer. And which is why they're going to use India as a strong base for their exports globally. And this is a trend that we are seeing in company after company. Given that India's base is small, some of these companies have revenues in three-digit crore numbers, and that's so small for in the Indian context. It can really go multiples from that. We think that if you're patient in this space and you find the right quality, sky is the limit. We are very positive on this space. 3-5 years, this space can really blow the top off.
Okay, thanks very much, Anshul, for joining in and sharing with us your thoughts on the channel. Let's quickly look at the.
If you like this video, then like, share and subscribe to ET Now.